Welcome to another episode of A Quest for Twice. Today is May 2nd, 2024. So in this episode, I'm going to go over more earning updates from companies in my portfolio. The first one is ILMN. So as shown in the figure at the bottom right, its gross margin peaked in the second quarter of 2021. In the last quarter, it improved due to product mix from 1 year ago. However, its sales declined by about 2%, led by Chinese business down by 13%. So look at the big picture as shown in the figure at the top right. Its gross margin looks like it's stabilizing around 62%, comparing to about 20% at its peak. Its core ops income, as shown in the figure at the bottom right, also stabilized slightly above $200 million per quarter. So the key question is really about future growth, and if a future margin will be able to recover to its historical level around 70%. So can the growth resume? It's really about its new equipment, the Novasec X, as shown in the figure on the left. Its quarterly shipment is declining after a peak in second quarter last year. That's because of the initial pre-order was fulfilled in the first and second quarters of last year. The cumulative base is still going up. Now it's a little over 100. So comparing to the Novasec 6000, there was a total installed base about 1,800. So there is still a long way to go. In terms of valuation, its enterprise value over gross income is 6.8 at this moment. That's based on $109 per share. That's an all-time low, reflects a very pessimistic view of the market in terms of its future growth, as well as the value of its grill business, which will be divested from its core business. So there are a lot of uncertainties left. The key one is grill may be spun off, and at what valuation level to the current shareholders. Another one is just about if the growth will be able to pick up. Now let's look at Aqua. Aqua reported a fairly solid second quarter. Its revenue declined from 1 year ago by about $100 million. Price normalization can explain about 10% of revenue reduction. Year to date, its volume went up by 6%. For the third quarter, management gave a EBITDA guidance of $215 million. So that's almost the same as the first and the second fiscal quarters. Importantly, the management revised its outlook down for the full year. Initially, it was between $900 to $950 million of EBITDA. Now it was revised down by $50 million. And the earning per share was also revised down from $17 to $16.5. The market did not like that and significantly punished the Aqua stock price. Now let's switch gear and look at the Mercado Libre. On this slide, the only new information is the number of users, including buyers and fintech users in the last 5 quarters. We can see both are increasing steadily, shows the network effect is still strong. In terms of its revenue, the first quarter revenue was higher than fourth quarter last year. On surface, that's impressive. However, it reflects accounting change related to shipping revenue Also, as a part of the impact of the accounting change, its last quarter gross margin was less than 1 year ago. The commerce services revenue, the gray bars in the figure on the top right, was higher than the fourth quarter commerce services revenue, which actually is misleading because the company changed its accounting of shipping revenues. In terms of the fintechs and the credit revenues, both are increasing steadily from previous quarters and also from the same quarter 1 year ago. The gross margin declined from 1 year ago. That's because of the accounting change of shipping revenue, which has an effect of depressing the gross margin. For the fintech business, the most important segment is the credit revenue and the credit portfolio. In the last quarter, credit revenue was about 42% of the total fintech revenue. As shown in the figure on the bottom right, we can see the credit portfolio start to accelerate from the end of last year after stagnating in the second half of 2022. Its net interest margin after losses declined to about 30% from a peak around 40%. However, this is not particularly alarming because the cause is more credit card debt comparing to other types of debt in the most recent quarter. So its fintech business is still fairly healthy. Now let's look at Google, aka Alphabet. As shown in the figure on the bottom left, its services revenue grew about 14% from 1 year ago. We can see in that figure the green line shows the quarterly revenue growth on a year-on-year basis after the dip in the second half of 2022. It has stayed above 10% in the last 3 quarters. Looks like that will be a stable trend going forward. Its Google Service Ops margin also stabilized above 35%. For its cloud business, you can see in the figure on the top right, the quarterly cloud revenue has been growing pretty steadily quarter after quarter. The orange line shows the year-on-year growth rate. We can see that it has come down from a peak over 50% in the first half of 2021, then bottomed out in the third quarter last year above 20%. Now has picked up in 2 consecutive quarters, approaching 30% year on year. No doubt the acceleration is partially driven by the investment in artificial intelligence, including generative AI. However, the growth rate is still significantly less than the huge boom experienced during the pandemic. For Amazon, it's a similar story. The first quarter revenue grew 13% year on year. That's actually slightly less than 14% in the previous quarter. The management gave an outlook of 7 to 11% growth in the second quarter. AWS grew 17% from 1 year ago. That's also an acceleration from 13% in the previous quarter. The advertisement segment is really a bright spot with a 24% growth year on year. The first party and third party sales were up 6% and 17% respectively. So overall, all segments are growing steadily with AWS accelerating because of the investment in artificial intelligence. On the margin side, you can see in the figure on the top right, the COGS, the gray bars, has been declining since 2020 because of the optimization efforts the company was undertaking after the huge build-out during the pandemic. It's a similar story with the fulfillment. Its cost peaked in first quarter 2022, above 17%. Now 2 years later, it's about 15.5%. Again, reflects the company's optimization efforts. So overall, its ops margin was 10.7% in the first quarter compared to 3.7% 1 year ago. That's helped by the COGS and the fulfillment cost reduction, as I just mentioned, but also reflects the company's cautious approach to other costs, including marketing and sales and R&D. Now let's take a closer look at the cloud business, as shown in the figure on the bottom right. I plotted the cloud business from AWS, Google, and Microsoft in their growth rate on a year-on-year basis. We can see all three cloud providers had a re-accelerating growth in their cloud business, with Amazon and Google accelerating much faster than Microsoft. But again, comparing to the peak during pandemic, the current growth rates are still about 20 percentage points less. It will be interesting to see how high the current growth rate will peak compared to the pandemic. On the margin side, I plotted the AWS ops margin. That's the dashed green line. We can see the AWS ops margin jumped from about 30% to about 38% in the most recent quarter. That's likely because of the revenue accelerating, but the cost is under control. I'll be surprised if it doesn't go back down to 30% as the historical norm of AWS. Meta Platforms had also similar story. Its first quarter revenue was up 27% compared to 1 year ago, and that's an acceleration from 25% growth in the fourth quarter last year. For the second quarter, its revenue growth guidance is about 19%. For the operating margin in the first quarter, it was 38% compared to 25% 1 year ago. That's because of the company was good at controlling its cost, holding the R&D expense flat despite the significant revenue growth. And the operating loss from Metaverse was 3.8 billion in the first quarter, compared to 16 billion in 2023. So at least the loss is not increasing proportionally to the revenue. However, the management increased the outlook for expenses. So in 2024, now the total expense is forecasted to between $96 to $99 billion, and the capex is forecasted to increase significantly by almost $10 billion compared to last year. that reflects the company's significant investment in AI infrastructure as well as research. This concludes this episode of Quest for Twice. Until next time, happy investing.